Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are here to try to help you with your retirement. We do that by answering your questions, so feel free to send them in now. You can do that through the chat here on the YouTube channel, or you can send it to this email, asktom@talkmoneywithtom.com, and we'll try to answer those right now if you'd like. Otherwise, you can send in an email during the week, and we'll try to answer that next week when we do the show again. So. Looking forward to that. Of course, we created this channel because we feel like there's a lack of education in the area of retirement planning, asset management during retirement, and tax planning. And so we've got lots of videos on that. We talk about what's happening in the stock market, trying to up your education on how to understand kind of day by day what's going on. So you can subscribe to the channel or hit the bell button, and we'll send out notifications whenever we put something up new. So. And then, of course, if you just want to, ask questions of Easton and I directly, you can do that by booking an appointment. There's a book appointment button up in the corner of our website, which you can get through the link here on the channel, and set up a 30-minute time to meet with Easton and I, and we'll answer your questions directly, whether you're a client or non-client, same thing. So look forward to being able to help you with any of the questions you might have. So we do start off every week with a, kind of conversation about what was happening overall for the week in the stock market. Obviously in retirement, one of the big things is, being able to have enough money to retire long term. And so the stock market is, one of the places to look, just because it has a much higher average rate of return than inflation, can keep your buying power intact. But it's a tricky place sometimes, especially recently as far as that goes. So let's take a look. All right, again, we've had this chart up for a while. This goes back to end of 2018, and we've just been adding to it week by week. And you can see, we had the big pandemic drop, and the drop that's right over our heads was the drop that came from Liberation Day, more or less.
It's been a pretty flat week. You had some up and down days, but overall, it's been a flat week.
Yeah, it was down on Monday, right? Down today. It was up a fair amount yesterday, for a variety of different reasons. I think, I'll start off the conversation that actually happened last week, right after our show got off, and after the market was closed. The appeals court determined that the tariffs that are being used under this emergency declaration were illegal. 78% of the tariffs and tariff revenue is under this emergency declaration, so it's kind of a really big deal. The International Court of Trade in New York had already, ruled that it was illegal. This was an appeals court with 11 judges. It was 7 said it was illegal, 4 said it wasn't. And I think the thing that's most interesting about that, 2 things. Number one is the fact that they didn't go after it the way that everybody seemed to be talking about. So, for example, it's supposed to be for an emergency, right? And so, you put a 50% tariff on Brazil because they're going to try to prosecute their former, president. He doesn't like that. That's probably not an emergency. The fact that we have trade deficits, most people don't think that's an emergency either, most economists, including myself. And so I thought they were going to try to attack it from the standpoint of, hey, these aren't emergencies. But what they did was a lot more interesting in the fact that they said that this particular, act that was done by Congress, I believe back in the mid-early 70s, doesn't allow the president to do tariffs at all. Doesn't say any place in the act that they can do tariffs. What it does say is the president has the ability to regulate imports. And so if you think about that, regulate trade, really, export also. So you've got the situation, for example, where Biden last year was putting restrictions on trade to China from some of the NVIDIA chips. So that would be an example of regulating, the trade situation. So, but it does not give you the ability to basically do a tariff, which is a tax. Congress is in charge of setting up taxes. Congress in the past has always been in charge of doing the tariffs, putting on how much gets on and how much, how fast it goes away, those type of things. It was a pretty convincing argument. I mean, basically the analogy would be the SEC is in charge of regulating the stock market, for example, is one of the things. And so, but it doesn't give them the ability to tax, right?
Yeah, so your capital gains tax goes from the IRS, not the SEC.
Right, and so that's what they're saying. Look, the president has the ability to regulate, but not to tax. That's going to be a hard argument to overcome, although the Supreme Court has been turning over the lower court's opinions left and right when it comes to Donald Trump, so we'll see what happens. But the second most important thing about this is that the actual tariffs that have been collected, which are fairly substantial, have to be refunded with interest.
Mm-hmm.
So 78% of tariffs collected so far could be refunded with interest. And so, Trump has asked that this be expedited to the Supreme Court. I've heard all kinds of different time frames. The lower court asked that, they take the case up by October 14th.
Mm-hmm.
But just because they take the case up doesn't mean they're going to rule on it. I've heard ruling could be immediate. It could be the end of the year or the beginning of next summer. What's interesting about that is if they do rule against the tariffs, they're still accumulating, and the refund just gets bigger and bigger.
Yeah, more interest, more tariffs you've been paid into.
Yeah, and it was kind of ironic because the bond market on Monday, after it had a chance to digest this, actually Tuesday, because Monday was a holiday, on Tuesday, after it had a chance to digest this over the long weekend, actually fell, because they're looking at these tariffs as possible revenue that takes the pressure off the bond market. And worse, if they're deemed illegal, they'll actually have to refund the money, and likely that refund money might come out of selling additional bonds.
It's like a double whammy. You have an outflow instead of an inflow.
Yeah, but the irony is that the bond market dropped when they put the tariffs on,
Mm-hmm.
and now the bond market is, dropping because they might take them off, right? So I guess with refunds, it is a bit of a problem. And so, that was kind of the beginning of this week, was dealing with this whole tariff issue, whether they're legal or not, what will happen. Now, there is another way that they can do tariffs, what's called the line item. I call them the line item tariffs. There's a different name for the actual act. But so, for example, we already have those. That would be steel, copper, aluminum, for example. We got 50% tariffs on those. And so, there's a threat for semiconductor tariffs even today, talking about that again. And so, that's going to be something that they can switch to if they have to stop doing this emergency version. But I think it's really a different dynamic. You go to Europe, you negotiate with Europe, you negotiate with Japan, South Korea. Now I'm trying to put tariffs on pharmaceuticals. Who am I negotiating with,
Mm-hmm.
right?
It's very hard to target a country versus like an industry.
Yeah, exactly right. So I would assume they're just going to put those tariffs out there. Apparently there are some limits. It takes longer to put them into place, and et cetera. And I won't bore you with all the details of that. But in essence, this is a plan B for them to try to continue these tariffs. It'll be a lot different looking than what we've got now. And I also think it changes the dynamic of these negotiations pretty dramatically, in the sense that if you're a country that is still, negotiating over these, you might want to just delay in hopes that the Federal Reserve actually the Supreme Court actually makes these tariffs illegal.
Mm-hmm.
So I don't think that puts the U.S. in a good position, and that's probably why Trump wants to get a resolution sooner than later, which does make some sense as far as that goes. So now then, for other parts of the week, Wednesday and Thursday specifically, we had up markets for kind of the strangest reasons, right? For starters, we saw that the job openings, which I have the chart here. This is core PCE, sorry. The number of jobs created this month came out today,
Mm-hmm.
right? So 22,000 jobs. Expectations was 75,000 jobs.
Yeah, much lower.
Much lower. Now, I will say this chart goes back into, January of 2022. It's been coming down. I mean, the trend is definitely down.
Yeah, with revisions, they're saying
Right.
less than 30,000 jobs have been created over the last 3 months.
Yes, and so it's down at a relatively critical level. We actually had, with revisions now, June was actually negative.
Mm-hmm.
That's the first negative month for job growth that we've had since 2020, when we had the big layoffs because of the pandemic. And so, we're seeing the market is actually responding negatively to this today, right? And it's kind of fascinating. There may be some other reasons that are out there, because what we saw on Wednesday was that the ADP report came out. And so this is the report that shows the number of private payrolls that were accomplished. And it was lower than expected.
Mm-hmm.
The market went up. Then we had, the number of jobs. Actually, that was Thursday. Wednesday was the number of job openings. And so that was down also 10-month low. Okay. So when you kind of take a look at what is happening, the market moved up on both of those.
Hmm.
Why? You wouldn't think it would. You got less job openings. You got less, private jobs. The market's still moving up, mainly because it's re-indexing the factor of rate cuts.
Hmm.
So the stock market loves rate cuts, and generally speaking, 12 months after rate cuts, the market's higher. Okay, on average.
Yeah, it's interesting though because a lot of times rate cuts are sometimes okay. Economy's slowing down. You want to speed it back up, but sometimes those rate cuts won't actually speed up the market fast or the economy fast enough.
Well, if the Fed has a hard job. They generally aren't perfect in terms of their timing. They are often late, and so you can start to do rate cuts that are too far behind the curve.
Hmm.
And you could make an argument now that maybe they are. Like you said, we've had very few jobs created in the last 3 months, and so the problem for the Fed is and this is why you're going to have lots of consternation going forward, is because of tariffs, they were also worried about inflation, and that's their dual mandate. And so if they're late, it's easier to see why they could be late because they're worried about trying to see the impacts of what could happen with the tariffs. But unfortunately, job growth, slowdown, job losses, those types of things are often associated with higher tariffs, especially at this level. I mean, the last time we had tariffs at this level was the early 1930s. Unemployment went from 6% to 25%. You had a global recession. And we're seeing some, precursors to that. We're seeing the long-term bonds, the 30-year bonds on countries, including the U.S., but around the world.
Yeah, Japan, UK, EU. It's not just the U.S. The 30 years.
Yeah, Japan hit the highest yield on their 30-year bonds in history. And so what that means is that when you see the yields go up, basically it means that the markets see uncertainty over the long term and they want to be paid more. Okay, so it's a sign of the market's unease, right? When you see the 30 years and the longer term yields going up like that. And so even though there's talk about cutting interest rates, the longer term is going up because if you have a big recession, that brings into account, the repayment possibility of defaults on different loans, private credit, that's out there. So that's the thing that we're kind of looking at here slowly but surely is just what, needs to happen. And so here's the key. In 2023 and 2024, especially in 2024, they were lowering rates. And the economy was good. Unemployment was at 4.1% roughly in that time frame. And you had a situation where they're lowering rates because inflation was coming down. And we ended up with 2 years of 20+% market returns. Go back to 2007. We're lowering rates because things are starting to fall apart, right? Just like they are now. I mean, gross domestic product is half of what it was last year. The job growth is anemic at best, right? There are a lot of great things going on with, the tax cuts and the, possible rate cuts and the, situation with the artificial intelligence. But when we look at, kind of what could be a drag for this, you can see it coming. Now, whether it causes a big recession or not, you've got several people running around with different arguments that seem to be very valid. So we're kind of in that muddle ground in the middle right now. It's where I feel like we're at. We got enough good news, good earnings and such to kind of make things look okay. The market's doing okay. Like you say, it's down a little bit this week, but overall the market's doing pretty well. The primary direction is definitely still up. And so, but there's enough things that said, hey, we haven't seen the impact of these yet. We haven't seen the impact of deportations. We haven't seen the true impact of the Fed losing its independence. We haven't seen the impact of what could happen if the Fed starts to lower rates in an aggressive manner. That might not work out as well as they hope. That could actually backfire. And so, we haven't seen, the impact of these tariffs per se yet either across the board. So that's the battle that's happening. We're in this muddle ground. I said August, September, October is when we start to see some of those impacts, and we are, so this is the beginning of that, and we're in that kind of, period of time. And so I think it's a very interesting time to see how things play out. We got tariffs that are now up in the air. You got the Federal Reserve. Now, the Federal Reserve, the bet for rate cuts went up from 2 rate cuts this year to 3.
Yeah, and now it's gone from there was 0% chance of a half point cut to there's 11%, I believe.
Yeah, yeah, exactly. So, 100% chance that you'll have at least 1/4%, right? And a 11% chance that you're going to have a 50%, a 50 cent, sorry, 0.5% rate cut. And so that's what happened last September. It was a surprise. Nobody was really expecting it. I can see why there's a bet there, because maybe they should have made a rate cut in July. They had their July meeting, and then right after the July meeting, they revised all of the, the previous 2 months down dramatically. And then they missed, the number for the month prior also for the jobs report. And so maybe if they'd seen that, they would have considered, a 1/4 point in July. And so I think that's kind of what happened last year, too, is that probably should have done something in July. They don't have a meeting in August, so it's kind of a makeup.
Yeah.
And they did a half. And I'd be a little surprised to see a half here because of these tariffs and other potential headwinds that might cause inflation, like the deportations and such, too. So, we'll see how this plays out as far as that goes. But it's been an interesting week. We had 2 up days that were basically up because the job market was weak. Today we're down with the job market being weak. We were down on Monday because of the tariffs might have to be refunded.
Yeah, I think
crazy.
I think it's a Goldilocks kind of zone with you want the jobs to be weak enough for cuts, but you don't want them to be too weak because then it signals recession.
Yeah, the problem is trend. Okay, so that primary trend is down.
Yeah.
Right. So, and that's what Jay Powell was talking about in August, was just the fact that the job market can get away from you, and all of a sudden you're sliding into 5% or something.
It goes quick.
Yeah, and because it kind of feeds on itself. Once people start losing their jobs, they can't spend money, and they can't spend money, other people start losing their jobs, and there's sort of this cycle that happens. And generally speaking, when that happens, they get even more aggressive with their rate cuts, and they do different things to try to stimulate the economy to kind of get some of those jobs back. However, when you look at this, chart right here, you realize that the Federal Reserve has had their rates up too high for quite a while. Because if their dual mandate is full employment, and we have the unemployment. Here's the unemployment chart, right? So it's the highest unemployment. It's at 4.3%. That was just reported today since we've had, since 2020 when we had the big unemployment. I think we got to 15% unemployment during the pandemic for a short period of time. But the Federal Reserve's target, I don't know, it depends on who you talk to. Someplace between 4% and 4.4%. Someplace in there is where they're kind of looking at. So I think they felt comfortable about leaving rates up because they felt uncomfortable about inflation. They were still trying to bring it down. And unemployment was still going to creep up because of that. And their very initial projections back before they started even lowering rates, raising rates to kind of bring down inflation, they projected that inflation would hit 4.4%, so pretty close. And at the time, we were at 3.4%, so it's a big difference. It's a lot of job losses in order to try to kill...
The unemployment rate.
Yeah, the unemployment rate, sorry. The unemployment rate would hit 4.4, so that's a lot of job losses from 3.4 to 4.4. And I remember a question coming up saying, hey, you're going to make all these jobs disappear, and they were and Jay Powell was talking about how important inflation is. It hits everybody, and it's it's a very destructive force, and it just continues to kind of multiply. So, that's where we're at as far as that goes. It's again, short week, but a lot happening this week with the different reports that are coming out and what have you. So we've got a couple weeks now. 17th is going to be 12 days from now. We'll have the Federal Reserve coming out talking about what they're doing in terms of lowering and raising rates. September is also a dot plot month. They do the statement of economic projection on the calendar quarters. And so, that'll be interesting to see, what their projections are going forward as far as that goes.
We're also going to a very historical or weak seasonality with red September is a very common one.
Yeah. It was kind of funny. We talked about that last year quite a bit, and I didn't hear much about it last year. But since 1928, September is the only month that's negative. I've seen a lot of articles this year
Yeah, well,
talking about it. And unfortunately, honestly, the more something gets talked about, the more it goes the other way. It's just amazing how that works. I will say a rate cut, even a quarter point rate cut, it stimulates the market. It may or may not be a huge boost in September. You do a half a point like last year, we ended up with a positive September, right? So we'll see what happens there. There is some wild cards that can happen that aren't normal as far as that goes. So anyway, that's our summary for what happened this week. There's again a lot going on, and we'll see it. We'll keep looking at it. We'll talk about it again next week too. So thank you for joining us for that part. Okay, let's take our first questions.
so what are your key takeaways from the report?
Key takeaways from the job report. Okay, so the jobs report just came out today. It is for last month, the month of August. A couple things. Number one, they fired the person that was ahead of the group that does the data and
Yep.
does this reports last month. So I was a little concerned with what would happen this month. Is this really an independent situation now, or are we politicizing the number? But it came out pretty poorly. I mean, it was 22,000 jobs versus 75 expected, and they revised again backward 2 months. June is now negative.
Yeah, negative 13,000.
Yeah, they actually upped, though, July from 73 to 79 or something along those lines. So anyway, I thought that was kind of interesting as far as that goes. It is kind of fascinating to me. If you're really angling for a rate cut like Trump is, then you kind of want a lower jobs number. And like you said, maybe the Goldilocks or zone where you have less jobs, but you're not losing tons of jobs, where you're really cycling downward. So that was kind of my first thought. Just obviously it's lower. I wasn't surprised at all. We're seeing a lot of, we're seeing less job openings. We're seeing less job creations. There's tremendous amount of confusion as to what to do.
Yeah, it was interesting though because some of the key, sectors that lost jobs was manufacturing and the government. And
Yes.
manufacturing is interesting because you'd think with tariffs that manufacturing would be spun up more.
Yeah, they did a big study on the 2018 tariffs, and manufacturing lost jobs from those tariffs. Because the irony is that you're trying to bring manufacturing home. But the reality is that you really can't bring manufacturing home because the cost of labor is so high that you end up, paying more. So if I had a 30% tariff, I might rather pay that than end up with 100% higher, labor cost, and because I'm actually better off with, that 30% tariff than trying to make everything here. And for the most part, manufacturing in the U.S. is not completely done here. It's bringing pieces from all over the world, which is a smart way to do it.
Yeah, and there's also been a shortfall in just labor in the manufacturing sector too. There's been missing a lot of skilled labor there too.
Yeah. So that the jobs report I think is going to be interesting. However, jobs are a lagging indicator. We have certainly seen that the jobs report isn't that accurate. It has to be readjusted and readjusted. So, you have to take today's number with a grain of salt. It could be adjusted up or down, going forward.
What about wage growth slowing? It went, the previous month, 3 months was 4%. Now it's down at 3.6%.
Well, it's pretty endemic. When you start to have a higher unemployment rate, wage growth is going to go down because the employees have less leverage. And as an employer, I've got 10 people applying for one job instead of one person applying for the 10 jobs I have opening or whatever it used to be. And so when you got a shortage of labor out there, you're really, having to pay more to try to compete and get that person versus what you're seeing now where there's unemployment creeping up. And you've got a situation where the employer's kind of got the upper hand there, and so you're going to see less growth in wages in those environments. I saw that too. It's kind of interesting. Unfortunately, it is in the worst part of that is in a backdrop of inflation growing at a higher rate. So we saw raw vegetables grow over 38% year over year in July. Grocery prices as a whole have grown 3%. So if wages grow 3.6, so theoretically, you're keeping up. Although the problem is 3.6 is probably a gross number.
Mm-hmm.
So if I make an extra $36 and I have to spend an extra 30 at the store, after tax I might only get to keep 25 of those dollars, and so
Mm-hmm.
I'm starting to lose out buying power at the store. This is what killed the Biden administration for all intents and purposes. Whether they deserve the blame or not is certainly impacted the election. And so you're getting this situation as we get closer and closer towards the midterm where prices are going up. And if wages continue down, it's going to impact the election, because people vote with their pocketbook more than anything, in my opinion. So anyway, I think it's an interesting report. It's definitely been, waited for all week long and even all month long, especially with what's been happening. But it'll help the Federal Reserve lower rates. It probably does bring into play the possibility of a half a point this month, and/or the possibility of 3 rate cuts between, September, October, and December, which are the next 3 meetings this year. So, yeah, I think that it was an important report in that regards.
So, would an equal weight S&P 500 index be a better leading indicator for economic health than just the S&P 500? Because you mentioned the S&P 500, but
Yeah.
because of the mega caps taking such a high percentage, is it kind of changing how we view it as a economic indicator?
Yeah, so the S&P 500 is capital weighted, which just means that the big companies are more important. The top 7, I've forgotten what the percentage is now, some 20, 35%, someplace in that range,
Mm-hmm.
of the S&P 500's motion is really around these 7 stocks. And if you take the equal weight, they basically do equal 500, stocks all have the same percentage weight. So when you look at, I think RSP is the ticker symbol for the Invesco equal weight S&P 500 that we generally look at. And so the idea would be that when you're looking at the equal weight, you get to see a more broad spectrum of what's going on in the economy because you see more stocks. However, you got to be a little bit careful there because the question is about economy, and the stock market and the economy sometimes are disconnected too. So, you're looking at a scenario where, hey, here, all 500 of these stocks are equal. They're going up. Does that mean the economy's going up? Well, maybe, maybe not.
Mm-hmm. Yeah.
So anyway, but yeah, I think it's a better representation as an index to look at for what's happening. However, as an investor, you want to be where the money's going, and the money has been going in these big stocks. It is a concern, right? Most of the market tops, and I think we're getting towards some kind of market top. We talked about that last week. We got potentially the most expensive, market in history, more expensive now than the run-up before the Great Depression, more expensive by most measures than the run-up that happened before the dot-com bubble burst. Sorry. And so, that's where you got to be a little bit careful, but that narrowness is where the market's been making. I mean, you look at the small cap index, it hasn't made money for a long time. It's made some great runs, but it's in this big old range and just kind of moving sideways. And it has a lot to do with the fact that small caps as a whole, their earnings aren't that great. They haven't been that great. The big caps used to be small caps, and now they dominate. The Microsofts, the Apples, the Nvidias, the Amazons, et cetera, that are out there. So I think it's,
Yeah,
it's
over the last
interesting
month
to look.
though, small cap has outperformed the S&P 500.
Oh
Though.
yeah. Matter of fact, one thing I've seen too that's not being talked about that much is that the international markets as a whole have been outperforming the U.S. pretty dramatically so far this year, pretty much across the board. So that's another way of looking at it too. There's kind of this global spread that's happening as far as that goes. Doesn't mean that things are healthy. So in other words, if RSP starts doing better than VOO, the S&P 500, does it mean the economy is more healthy? Usually, actually, because it's showing a broadening and a higher level of risk that people are willing to take going down into these more mid-cap stocks. And so is the global economy doing better than the U.S., a sign of health? I think in this case it's just a sign of people being distrustful of the U.S. and starting to invest in other places at this point in time and kind of worried about what might happen here. So maybe that's a little different. But anyway, good question.
Is it too late to invest into the AI sector? What are the pros and cons of investing now when it's kind of at a, very high price?
Okay, so if we take out tariffs, we take out deportations, we take out the independence of the Fed being attacked, right? You take out those three biggies. You basically have what was happening in the dot-com run, in my opinion, 95 to 2000. If you look at kind of the things that were happening and how that works, right? We are at best in the middle innings of the AI,
Mm-hmm.
okay? I mean, at best. We're still dealing with companies that actually make money. We're not to the crazy part where we're dealing with companies that aren't making money yet. We don't have this wild IPO market. That might be coming, right? Because what happens is you get all this private money right now that's coming into AI because it's so, potentially great
Mm-hmm.
that you don't need to go public. Well, eventually that private money wants their money out, and that's how they do it. Generally speaking, they go public. But those are the real businesses. What we saw in the dot-com thing, especially, out of that 5 years, in the last, say, year and a half, was this scenario where it really got crazy. We're not there yet. So there's potentially a huge amount of run, in my opinion, to the upside in the AI space. What do you buy? Obviously NVIDIA is a good example as far as that goes. There's all kinds of different things to take a look at, things that even might be following up, like quantum computing that might come behind AI
Mm.
because they need that power and such too. So there's some areas that are very exciting. However, you can't ignore the fact that the market could take a hit here from tariffs, deportations, and loss of independence of the Fed. And so it's kind of one of these things that, does that create enough headwind so that nothing's really making money,
Mm-hmm.
even this exciting area? And let's face it, we were talking last week that 95% of companies that have instituted some kind of AI project or, what have you, has been unsuccessful in terms of making money, right? So they haven't figured out how to really make it monetize, which is the same thing that happened in the dot-com. We were all talking about how Google and these companies, they're not making any money. Facebook just getting a lot of clicks, not making any money. How are they going to make money? I remember a guy that said he'd eat his hat if Google got to $500, because they weren't making any money. Well, I don't know what the splits are now, but Google is so far past $500. So that's not unusual. That's kind of what happened before. So if you look at it from the pattern of, dot-com versus AI, we're at best in the middle and maybe even, before that in terms of the overall run. But I think I would be very careful here personally just to see what the impacts of tariffs, see what the impacts of the deportations and the Trump and the Fed independence. So take it small, take it slow, buy the dips, accumulate, buy things that have fairly high quality at this point in time.
Yeah, I think if you're going to buy at a high point, you have to have high conviction. You should be willing to see if this, stock goes down 20%, are you still willing to buy, or 30%? Are you still willing to buy it? That's one way to think about it when you're buying into a high point.
Yeah, Warren Buffett had a saying that basically you should expect every stock that you buy to drop 50% right after you buy it, and your conviction level has to be high enough so that you still want it, and you still want to own it, and you still maybe even want to buy more,
Mm-hmm.
right? So that's a good point. And so that's where you want to be right now. You want high conviction stocks, smaller dollar amounts, dollar cost averaging, buying the dips, in my opinion, just because of these tariffs. Otherwise, honestly, I'd be all in.
Mm-hmm.
Right? You take away these pieces that are potential headwinds. I think the parts that are potentially drivers are big enough to really, the tax cut bill, the deregulation, the situation with the lowering of taxes. Sorry, Fed funds rate. All those type of things. Those are really big tailwinds that can help a market tremendously. So, yeah. I'd be a little careful because it is a more volatile segment. It's already highly priced.
Mm-hmm.
Yeah, and so it will have some drops here and there. Just be willing to accumulate more. If there is some really big drops, maybe sit back and wait, and you might be able to really get some good deals. All right. What's our next question?
What happens if the U.S. government needs to actually repay the tariffs and interest?
I'm going to make a projection that I think they resist tremendously paying these back, just based on the
Yeah,
personality of
they'll make it tough. They're
the
gonna make
White
it.
House. Well, they might make it impossible. Uh, so we'll see what happens. That's just my thought. I'd be kind of surprised if we start seeing all that money going back. But apparently you have to file for it. That's what I read about this week. And so we'll see how that plays out. There's been a lot of, after that ruling, there was all kinds of, these import agents and export agents getting questions about, how does this work? Oh, it's going to change pretty dramatically what people are ordering, right? Why would you order anything right now if the Supreme Court might rule that those tariffs aren't legal soon? So, you're going to lower your ordering. If you have inventory, you're going to let it run down, and you're going to kind of keep it slim while you wait and see what happens with these tariffs. It's a big deal. I think that court ruling changed things quite dramatically. So anyway, I think the repayment portion of it will be. We've already seen it. The bond market took a bit of a hit on Tuesday on the thought process of having to repay this, and maybe even more importantly, the thought process of not having this extra revenue come in. The bond market's going to have to make up that differential for these deficits, and so it'll be very interesting to see how that repayment plays out. Yeah, it's a good question.
Do Treasury yields change when the Federal Reserve cuts rates?
Treasury yield. So Treasury is a big number, a big word. It covers from 30-day T-bills to 30-year T-bonds or Treasury bonds.
Yeah.
And so it depends. Theoretically, what happens is the Federal Reserve is lowering the short-term interest rate, and basically it's the rate that they charge the big banks, right, for money. So what happens there is that when the rates come down, theoretically, the entire curve of yields across that time spectrum from 30 days to 30 years will all start to come down. But there are some exceptions, and this could be one of them. Sometimes you see the short end of the market come down, like 2 years or less, will come down just because the Fed is controlling that shortest end or influencing that shortest end. They don't control it the most, but you could actually see like the 10-year and 30-year yields go up in that environment. As a matter of fact, the difference between the 30-year and the 2-year right now is pretty high. As a matter of fact, it's almost historical.
Yeah, because last year in September when there was cuts, the long-term treasuries actually went up even though there was cuts.
So why does that happen?
It's people are feeling uncertainty. Is this going to be, there's inflation still existing. Is the government still stable enough to pay debts? If there's any uncertainty, you would want, or any more risk you take on, you want a higher yield. And so we'll likely see if they cut rates, the market will decide the rates, not the actual Fed.
Yeah, that's the problem with running around, saying, oh, they need to cut rates, we need to get mortgage rates down so people can buy homes. Just because you cut rates doesn't mean mortgage rates are going to go down. Mortgage rates are tied mostly to a 10-year yield. And so if you're looking at the United States over the next 10 to 30 years, you might have some concerns, as a bond buyer, right? The market acts, as a bond buyer. And so what happens there is you might want a higher rate of return because you're worried about the future of the country. When you look at, especially the Fed independence thing, that's got to drive the bond market crazy eventually. And so, we're effectively trying to fire this one Fed governor. That's in court. They're, going through Congress right now with the potential replacement, and so they're trying to take over the Fed board, and then in May they get to replace the chairman if they don't do it before. So anyway, that's where the bond market will be interesting to see what happens in that longer term arena. You may not get lower mortgage rates just because the Fed has lowered rates, and so usually it does come down, but this has been a little different across the board. If you look at 30-year bonds across the board in different countries, like Japan and all, Japan's the highest yield it's ever been. That means that there's concern about the future, a global economic slowdown, and or depression. The last time we had tariffs at this level, we had global economic depression around the world. And so all of the countries end up having to pay more on their long-term debt because of that uncertainty, right?
So, this is it better to invest in the Nasdaq versus S&P 500 over the long term? You know, if you look at the 30-year return, Nasdaq has vastly outperformed the S&P 500.
Yeah, it's kind of interesting. The Nasdaq has the most, has more tech.
Yep.
Right. And so the Apple and Microsofts and Amazons, they all listed on the Nasdaq. At the time, especially, the Nasdaq was the computerized, network and trading system, versus the New York Stock Exchange was physically on the floor of the New York Stock Exchange, and that's changed a lot now. But nonetheless, a lot of great companies ended up listing on the Nasdaq. And you had some of the older companies, let's say, for example, the Caterpillars and IBMs and Boeings and what have you. And I'm actually not sure if those are listed on the New York Stock Exchange, but I bet you they are. You had some of these older industry companies on the New York Stock Exchange. And so the S&P has a bigger spread amongst the kind of older firms and the newer firms.
Mm-hmm.
Size-wise, you get more small cap in the Nasdaq than you do in the S&P 500. The S&P 500 goes down to mid cap, but you can get some small caps in the Nasdaq.
Yeah, the S&P
obviously,
500
too.
is a much more matured index.
Yeah.
While the Nasdaq, you could say right now, is a mature index, but if you go back 30 years, it was in its infancy.
Yeah, I think you need a time machine to really take advantage of that, because I don't think they're quite as different now as they were back then. I mean, I very specifically remember the NASDAQ, the pink sheets and all this stuff, and it was a totally different index. Now it is, now the NASDAQ is much more mature also. So, I'm not sure there's a massive differential here in the short term or looking forward between the two. I like technology. I think it's one of the things we do really well with, but it is a bit more of a narrower index.
Yeah, and there's also the Nasdaq had its trouble years in the early 2000s, where after the .com, it took a very long time for that to recover, and
Yeah.
so I don't think you can say past performance can ever 100% represent future performance again.
No, because it's a totally different index than it used to be. Yeah, I remember the Nasdaq hit the 5,000 and somethings in the big run up at the end of '99, beginning of 2000, and then it dropped down, I believe, into the thousands.
Mm-hmm.
And there was all kinds of articles saying the Nasdaq will never ever get back.
Never recover. Yeah.
Never get back to where it was. And now look, it's in the 16,000 range or whatever it is, right? So yeah, it's still a good investment, but you're talking about really some of the greatest companies in the world that are on there as far as that goes. So anyway, we'll see how that plays out. But okay, that's it for today. I want to thank everybody so much for coming. Again, send in your questions. You can send them in to the email for this next week. We'll try to answer them next Friday. At asktom@talkmoneywith.com. I'll do my daily videos Monday through Thursday, talking about what I saw happening in the market. We'll have our show again next week. The week after that, we're actually off on the 19th, as far as that goes. So we'll see how that. I'll probably do a summary, but we won't have the show. And nonetheless, if you want to subscribe to the channel, continue your education, start looking at what we have on there, hit the bell button for notifying when we put new content on. And then lastly, of course, you can just meet with Ethan and I if you'd like, phone, video, in person, 30 minutes. Go to our website, links here on the channel. Up in the corner is a button, looks just like that, book an appointment, and you can pick out a time that works for you, and we'll meet with you and answer your questions directly, whether you're a client or not client. We'd be happy to. We like to help, so we're here. So anyway, look forward to seeing you again next week, and thank you for coming to this show. My slides weren't in order. I didn't practice them, so I had to stop using them. I wasn't sure what was next.